I'm here with Niclas Sandström, the co-founder of Hilbert Group, and today we're talking leverage.
Thank you. Excited to be
here. You run asset management, a crypto company that also does asset management, and you have a long background in finance from the hedge fund world. You have a PhD in physics, right?
Yes.
Yes. Right. So quantitative as it gets, maybe. And today we're talking about leverage.
Yes.
I understand you have a special view on the leverage.
It's more like, as we've talked or mentioned in discussion before here, that leverage is usually what will kill you, not only in crypto, in traditional finance as well. And I sort of like one quote, if I set the scene, from Charlie Munger, the late partner of Warren Buffett, who said that smart men go broke in 3 ways, and it's liquor, ladies, and leverage. And and the thing, on a more serious note, in terms of algo trading and running algo trading where you don't really see what's going on, you might be asleep or there's code doing the trading, and having leverage when something goes wrong is very, very dangerous. So hence you must be very defensive. And I would like, there's a trading maxim, I'm going to give a bit of background, how we view positions in relation to leverage, but there's a trading maxim that says that leverage can never make a bad trade a good one, but it can make a good trade a really bad one.
Yeah.
And I'll explain in a bit what we mean by that. But if you consider any portfolio, you can have long or short positions. If you run a short position, you will be leveraged no matter what. It's intrinsic to a short position to be leveraged. So for example, if you're short, let's say, $100 of Tesla, and the Tesla goes 100x, the problem has multiplied because you would have to go back and buy it much more dearly. So there's no real theoretical downside. There's no theoretical capped downside to a short position. So the upside is capped because if you're short $100 on Tesla goes to zero, you've earned $100. But it can theoretically go infinite. So you have limited upside and unlimited downside. If you're long, it's the other way around. So the way leverage come in for us is that when you have an algo, the first thing you need to make sure is that not something goes wrong with leverage if you're running a leverage position. So usually people say we don't run any net leverage. What it means is that you're long some stuff, you're short some other, and on average, you don't run much leverage.
Yeah.
But that's where, and a lot of funds that blows up, that's where they blow up, so to speak. And hence, I would say it's the single most important parameter for an algo, leverage, or the choice to run leverage versus not to run leverage. Of course, if you get things right, with leverage you can amplify your return,
a lot,
but it's the same with the downside.
Well, I could tell a very recent history that I've been telling in the podcast, that I had a view, and I even told it at the podcast, that now I went long, leveraged Bitcoin.
Yeah.
And it was at 90,000, something like that. And my view was that with this, there's a magnetic pull towards 100,000.
Yeah.
And today, the day of this recording, it just reached 100,000.
Yes.
And on the way up, I blew the position due to leverage.
Yes.
So on this day, it was right. On this very day.
Yeah.
And the good trade became a terrible trade. As you said.
It's very interesting that you mentioned this, because when you run leverage, your return becomes path dependent, just as you said.
Yeah.
It doesn't matter. So let's say you run a four times leverage position. It doesn't matter if that position drops 25%, you wiped out.
Yeah.
But eventually you might have made 10x, but it doesn't matter because in the end
You're
you were
out.
right. But what was directionally a good trade was made a bad trade because of leverage. If you would have been unleveraged, you could have sort of
Survived.
yeah,
the whole
survived
thing.
it. And that's the history is full with corpses of various companies actually, and it's because of leverage.
It's absolutely, and I used to be a derivatives broker, and
Yeah.
I seen this hands on, and during the COVID crash, I had many clients
Yeah,
that went, and even very competent, nothing wrong with the reasoning, and even hedge funds
yeah,
that went under due to leverage.
yeah,
And a very funny story there is I had a guy who called me, and he wanted to short the Norwegian kroner against the euro. And okay, sure, should we put it on? No, he wanted to day trade that position,
okay,
and I had to ask why. I mean, what's really your view here? Because let's find a position, put it together according to your view. No, he wanted to learn how to day trade that position. Okay. And he drove from a long, like a 7-hour drive to come into the office. We sat down. I found the whole thing very strange. This is not the usual. And and didn't have much money, but like good money for like a retailer, but not like. And okay, I mean, are you sure? I mean, I don't know. We can structure it some way. No. Okay, good. Here we go. Out the door. He drove back. And I was talking about him regarding like a seat belt. He was driving here. Like the reference uses seat belt, so when you crash, you don't die, right? So have some sort of to protect your portfolio, right? Don't put. So even though my position blew up, it was still a small part of the whole.
yeah,
Right. So I'm still alive, right?
yes,
No, I drive without the seatbelt. What? This is a very strange. I mean, this is strange all over. And what is it called? Träskor. He came with träskor into the office. Yeah.
okay,
And this guy, he went back and he started day trading with high leverage, like 30x, something like this. And he was in, out, in, out, in, out, in, out. And he was only the same position. He was shorting, and in, out. And it was at the same time, it was quite famous, the hedge fund then, but I won't mention it at the time. But they had the same view. And they just added on to the position. And the hedge fund blew up under the COVID. And this guy somehow managed to make a profit. and after a while, I was like, are you going to pull it out? I mean, you've been right. I mean, you did something right when the professionals blew up here.
Yeah.
And he withdrew his money, and I remember the last call we had was Merry Christmas. And I called him to tell him Merry Christmas. He was, oh, so nice of you to call. Nobody has called me today. So that was a little bit of a sad story, but that was his guy. But it turns out that with that, because I was thinking a lot about this in terms of with leverage and this story, and what he did, probably, or maybe I don't know, but he just did it. Was risk mitigating all the time.
Yeah.
Right.
Yeah.
He was fairly good at risk mitigating, and this other fund that had a lot of money, it blew up the fund, right?
Yeah.
Because they had this huge exposure at the end, and probably a mean reversion type of strategy, something like that, and it collapsed.
It's timing is everything, and also size. If you have a short position and it goes against you, your problem grows, right? If you have a long position and it goes against you, the problem actually becomes smaller. Let's say you're not leveraged, you lose 50% down, but now you only have 50% exposure. But it's the other way around for short. And it's also, when you have a big position like that hedge fund might have had, sometimes you're stuck. Let's say you have a huge short position. the only way you're gonna get out of it is buying, right? You have to buy back, but by buying it, you will drive the price even higher. So there's so much. One really has to be careful, and typically in FX we see small moves in, dollar, euros, and so on, and some professionals might run 10x leverage, but to run leverage in crypto, and you can
With
usually
such
have
volatility.
you can have spikes. I saw one thing I experienced personally was I went to the loo. It might have been 2:00 a weekend. This was many years, maybe 2021 or something like that ago. And Bitcoin in that period of time, I was away maybe 20 minutes, dropped 40%. So and then you see people that run. There are people who are running 100x. They allow 100x, but it becomes pure lottery, right?
Yeah.
You're so easily wiped out, and even 10x is insane in crypto.
Yeah, with
But a
the
lot of people run.
volatility,
Yeah. So one really has to be careful, and it feels like it can't go more down more than this, but you never know.
That's always the trends can last and the moves can last and they can go and it can be much worse. And also from the mathematics, what fascinates me a little bit, the nature of it. So when you lost 50% of your account, you need to double it to get back.
Yeah,
It's a much bigger move.
it's a 50% down move, but you need a 100% move to get back.
Yeah.
Yeah.
And and 50 is hard to obtain to begin with, and
Yeah.
yet 100, right?
Yeah.
And it really unravels a lot of difficulties. So how do you do it? How do you manage risk and what you talked about, like you said, like implicit leverage, like a short position is.
Yeah.
So how do you manage that in your funds?
Two funds, they are not leveraged at all, so there it's fine.
Long
And then-
only.
long only, and no matter what happens, the exchange go down for days, doesn't matter. You don't have any positions on. You have a position on, but it's not leveraged. So, but in terms of the long-short funds that we run, you have to be, first of all, very defensive in terms, if you look at the code, because it's algo traded, so you have fail safes trying to cover every angle. And of course, the road test having been run on meaningful amounts of money for a long time to see that, but for example, you need to have internal checks. So for example, you need to have an internal representation of what your order book should be, to keep track on what looks like a dirty data point, or did my order go through? Simple things like this. Okay, the algo sends a trade order. Did it get a confirm back? If it didn't get a confirm back, it doesn't mean necessarily that you don't have a trade or add it to the position, because something might have gone wrong there, and all these layers.
Yeah.
But also keeping limits on how much you do in each single currency. You can have stop limit orders in by automatic. So even if you lose, let's say, connection to the exchange or whatever happens, those orders are still out. And that full range of things that you need to do. And also keep the leverage on the short side, like the absolute leverage, so absolute level of shorts plus absolute level of longs, that is sort of very balanced and just running, a moderately leveled.
To really take use of the correlations that are in the market.
Yeah. So it's just very cumbersome and nitty gritty to do right, and disastrous scenarios can happen. But so far it's good, and we don't, even in absolute leverage terms, we don't run much. But you can run some, but it's always dangerous.
And when you run the leverage positions, so to say, are they really high frequency, or are they going over a longer period, or how are they structured?
We're running it over a longer period. We're not running high frequency strategies yet, like the strategies we have. So when I say high frequencies, usually you have many orders per second. It could be hundreds or thousands. We don't do that. We might be checking the market order of magnitude every minute for rebalancing. That's what we do. So, in a month, maybe it's like 10,000 trades, something like that. So it's not super high frequency.
On all the funds?
No, for a given fund.
For a given
for
fund.
example, it also depends on the vol in the market, because we are like mean reversion traders, so we rebalance. The higher the volatility, the more trades we're gonna do. So it depends a little bit from one fund to another.
Yeah.
But that order of magnitude.
Yeah, that's a very interesting subject, really. As I mentioned, I used to work for a quantitative fund and really research company. That's the core of it, right?
Yeah.
And some of the findings that was done there was that the expected return went down a lot with the frequency of the trades.
Yeah.
And so the longer holder period, better significance on the signals and everything. And also, when I later became a broker, I could extract the data from all the traders and just plot it. So I had this quantitative background, super fun to have real data to check what are people doing. And my view is also that, it's people moving the markets, not like a number or something quarterly, something comes up. No, that's just the excuse of the people's reaction that's moving the market, right? So it was really interesting to see the data firsthand. And I saw the exact same thing when I plotted it out, just on the chart. You didn't even have to do a regression line. It was just so obvious that and that's with leverage positions. If you turn down the frequency, the higher the return. Or said on the other way around, when you increase the frequency and that could be really, really high at some accounts, right? They didn't really make any money. It was nice to be a broker then, it was spread all the time, but to them it wasn't. And I think a lot of time with the psychology, when the greed kicks in, and maybe I think it's very natural, and most listeners are probably not algo trading, but like personal, that the leverage is really a tool for greed. That's what it is. And when something goes south, or when it has gone really well, the greed increases. You either want to get back at the trade or
earn even more.
Or earn even more because you're the best ever, right? And that then you increase. So maybe your view is correct, but you increase the leverage and you also increase the frequency. And then you go down the exact path that statistics shows lowers the returns.
It's a common so for example, if you look at the frequency of trading, all things being equal, if you have low frequency of trading, inevitably you're going to have high volatility, or for any generic portfolio, because it's more. So the low volatility strategy is like, ARB or market making, which is high frequency. They have low volatility. But there comes a point, depending on what size you do. Let's say you did the same size, low frequency, and the same size, high frequency. You can overtrade. A lot of people do it even manually, but you pay so much in fees, but you don't see it, right? So if you're doing 100 times more trades, and every trade you have a fee to it, not every trade is going to be a winning trade. So it's easy to overtrade, even when you're playing around and designing some algos and running. It's so easy to just, pay away everything in fees because your algo didn't have an edge. And if you trade high frequency, you will notice that much quicker because it's just going to.
And then you're back to, if your strategy has 50-50 on the back test, and then you add the fees to it, that will be the casino tilt. That will be the, you have the red and the black, and then have the green, right? The little edge to the market, that will be the fees.
So even if it's a fraction of a basis point, but if you do 100,000 trades with no edge a day, it will soon dwindle down.
Yeah, that's very, very hard. So how can people utilize leverage, or should they even?
I think I believe in discretionary trading as well. Like we do algo trading, which means we have a model for it, we have back tested, we have a specific algorithm for how it should trade, and we believe, that this has an edge in the market. But you also have discretionary traders who have been sitting and staring at the screen, who have a feeling for the market. And I genuinely believe that there are some hardcore, quants who think, no, discretionary traders, they don't have an edge. But I've seen it and I firmly believe it. It's very hard for a discretionary trader to explain their edge. They just sort of are in sync with the market.
Yeah.
They can't say exactly, but I've seen people being consistent over decades in discretionary traders. And in terms of leverage, then I think you get a feeling. So in an algo, for example, if you take it from an algo context, you might have signals who gives a very low probability of a down move, say, because the algo has crunched a lot of data and now you have this setup in the market. Then it might be positive expected value. Okay, low probability of down move, let's leverage up. And that's what a discretionary trader does intrinsically. And I think you can, if you have sound models, you can time that and you can sort of allow yourself a bit more leverage. But you can't go far out, right? Because anything could happen. The exchange could be hacked in any instant, like in crypto in particular, and you might have a spike because of that. So you can never feel, you shouldn't be betting the entire portfolio of that. But if you look at individual positions, or if you trade at, let's say you have a hedge fund, you trade on several venues, that's a sound thing to do. You can allow yourself, some leverage when all the stars are aligned, or your algo is saying, okay, it's a low probability. But it's always going to be a risk because you never know. Next second, it might be a hack or something nasty happens, and and hence people are, from an expected value point of view, you try to squeeze out more. And in general, I think, there is a place for leverage. It's just that it's overdone by most people.
Yeah, and also what's I think it's often overseen or ignored, or I don't know what to call it, but like you can have, and most people probably have, at least on a private retail point of view, you have like uncorrelated leverage. So for example, if you have a mortgage and you have a portfolio, you could have had less mortgage and no portfolio, right? So and you owe that money, but you also have it on the other side. So that's indirectly leveraging, but it's uncorrelated. So you're not gonna gonna be forced to sell. Well, if you stop paying a mortgage, but that's probably not due to the market. And leverages like that, or in stocks, you can also achieve, with more volatility on the leverage in the companies themselves, right? For example, let's take shipping companies. That's I've been around with the shipping companies, but there's very different capital structure of the shipping companies. And when the tide kicks in, when everything is good, everybody's making money, it's a big difference. And you also have the operational, not necessarily the financial, but the operational leverage there that also can be used by a trader to maximize the move. If the thesis is, let's say, not technical, it's not a model saying like this and this and this, but it's like I see the rates are going up and I believe in, or something. A thesis that will not, force you to have the direction correct as well.
It's and one thing about leverage that easy to miss, or because it's like a slow bleed, is that you have negative carry, which comes from you have to, essentially what you're doing is to short something, for example, you borrow and you have to pay a small fee. In crypto, typically, that's the funding rate. Typically, the longs pay the shorts the funding rate, or it could be the longs as well as who pays the funding rate. But and it's been 10% per year, roughly. So if you, let's say, you're on Binance, you are going leverage long, meaning that the extra leverage is $100,000. So per year you will pay $10,000. That's a meaningful cost to run that. And this negative carry over time can be much higher. So when there's a lot, and I'm coming to like the system leverage as well, you can have, as a portfolio manager, you can have leverage, but you also need to worry about the leverage in the system. So, and you see this in crypto so well, like if it's at the peak of a bull run, everyone is leveraged, and the funding rate is much higher. It may be that people pay, insane amounts per month to have that, because the funding rate is not 10% per annum, it might be 50% per annum or something, if you analyze it. But then the move becomes much larger, right? If you have systemic leverage when everyone wants, and we've seen it in crypto, we've seen it in the structured credit crisis, where you have a huge systemic leverage. So everyone, when they want out, everyone wants out at once. And hence you get a much higher move than your backtesting was telling you, because you were only backtesting a certain period. So it's those things to be aware of as well.
That's a very interesting point. And I often look at the options volumes. And I think it's more, that's just a thesis I have, but it's more sensitive in the crypto space than in the stock world. And when you see a lot of open interest, because the lot of open interest and the net positions you can see in the put call ratio will tell you a little bit also about the systemic leverage. But this leverage will expire at a given date. And then you have billions of dollars of incentives for this to expire, not in the money. And then you have something to view also for I read somewhere at one time that like 80% of the stock options expire worthless.
It could be.
So the individual, not necessarily all the combinations, but like the individual stuff. And which makes sense when you combine all the options. Often the purpose is that one goes away and four of them are financing the one. So your strategy is actually for a lot of them to expire worthless, right? So it's overall, so if you just change your portfolio to a call option on a Bitcoin, you are 80% or something, I don't know what it is in the crypto world, against you. It's
and that's right. And part of the reason for that is also people like, at the money options are expensive. You usually want, and then you have 50-50, more or less, like at the money. But if you do out of the money or deep out of the money, I mean, some do for insurance reasons or they hope for a crash. If you have a put deep out of the money, cheap, you're going to make a shitload if it goes your way. So hence it will be, but in those occasions, less than 50% that you will going to end up in the money. But it's interesting, but it is maturing. And I think it will converge at some point. It will become traditional finance in a way, in terms of infrastructure, in terms of liquidity, in terms of security of service providers, etc., etc. You rarely hear about a hack on Nasdaq or something like on, let's say, a malfunction of the exchange in the traditional finance world is quite rare.
It is. It's really, so the word out there is to be careful leverage.
Absolutely.
There is a time and place.
It's the number one killer, I think, in terms of private portfolios.
And it must also, because the other side of it, it must be like the dynamics, a professional actor as you, and you have, the whole squad of PhDs with each 20 years of experience in the hedge fund world. So, that's essentially Hilbert Group. Like you are competing against crypto bros, leveraged, right? In the markets.
Some of it, yes. I mean, you have a lot of retail traders trading on the same venues.
So in some way, do you feel it's taking candy from a baby?
Not necessarily. It's. I think it's more so, even more so with which they've been criticized for. But if you're a market maker, high frequency, there you have more like. But of
Yeah.
course, I think we have an edge versus the average retail. But it's it is what it is, and at some point, the game becomes more like in market making, or like in a very mature market, it's more like the professionals against the professionals, and the margins, are going to be very thin. If you have a long-term view, however, it's like if you have low frequency trading, there it's easier to maneuver, and if the competition is hard, right? If the competition is super hard in low frequency trading, it's all about the technology. Who has the fastest? Who has the best? Like who has the most complete picture? Who has the fastest rails? Who can execute the most orders, and so on? It's more a technology game, whereas you have more, and it's very costly. Whereas you have more leeway in lower frequency trading. But it is what it is. Most people sit there at home, day traders, over trading, and they are at a disadvantage, for sure.
Yeah, well said. Until next time.
Thank you.